Hello, I'm John Ward on behalf of Anglo Far East and Physical Gold Fund. We're delighted, as always, to have with us here Jim Rickards. Mr. Rickards is an investment banker and investment advisor in New York, and he also serves on the Investment Advisory Committee for Physical Gold Fund. And he's the author of a new book, The Death of Money, The Coming Collapse of the International Monetary System, just published and now available on Amazon and, I would hope, in good bookstores everywhere. Within 1 week of publication, The Death of Money has reached the status of New York Times bestseller, both as a hardback and as an ebook. Jim Rickards' first book was The Currency Wars, The Making of the Next Global Crisis, also, of course, a New York Times bestseller. Welcome, Jim, and thank you for joining us.
Thank you, John. Great to be with you.
Well, Jim, first of all, congratulations on the publication of The Death of Money, and I'm not surprised by its early success, though it is very impressive. The book is a compelling read, and it's very powerfully argued and incredibly well researched. And today I'd like to talk with you a little bit about The Death of Money. But first, I think we should spend a moment on the dramatic title. What exactly do you mean by The Death of Money?
Well, John, by the death of money, what I mean is a collapse of confidence in the value of the U.S. dollar. In other words, in the dollar's role as a store of value. And, it's a provocative title, The Death of Money, and the subtitle, The Coming Collapse of the International Monetary System. So it's a bit provocative, but it's not really meant to be, in the sense that the international monetary system actually has collapsed 3 times in the past 100 years. It collapsed in 1914, in 1939, and again in 1971. So these things do happen. They seem to happen every 30 or 40 years. It's been a little over 40 years since the last one in 1971. That doesn't mean that the system collapses like clockwork tomorrow morning. What it does mean is that we're probably at least based on history, at the end of the useful life of an international monetary system, and we're getting ready for a new one. And I try to do 2 things in the book. One is explain the dynamics of this. I don't think it's enough for a writer or an analyst just to throw out provocative, conclusions or warnings without giving the reader the backup, the research, the resources they need to form their own judgment. So I'll say some things that, as I say, might seem a little bit extreme, but it's got over 300 endnotes. We were sort of helpful to the reader. We put them as endnotes instead of footnotes, so we wouldn't clutter up the text. But they're all there. And if you read something in the book and you want to know more, or you disagree, or you just like to drill down a little bit, those resources are all there, so we'll let the readers draw their own conclusions. But we explain the dynamics, why the collapse is coming, what it means, and then look into the future and look at what the new system will look like. And when I say the new system, we mentioned these 3 collapses. Each time, it was not the end of the world. People did not go to caves and start eating canned goods or tuna fish. What it meant was that the major financial and trading powers of the time sat down in a conference around a table and rewrote what they call the rules of the game. I love the phrase, the rules of the game. It's not mine. That phrase has been around for 100 years, but it's shorthand among international monetary experts for however the international monetary system is organized at a particular point in time. So, for example, after the 1914 collapse, there was a monetary conference in Genoa, Italy in 1922, where the major powers of the day rewrote the rules of the game and came up with a new system. After the 1939 collapse, there was a larger international monetary conference, very well known, in Bretton Woods, New Hampshire in 1944, and they rewrote the rules of the game. And then after the collapse in 1971, when Nixon took us off the gold standard, there were a series of conferences, the most famous, the Smithsonian Agreement in December 1971, but there were subsequent meetings all the way up through the Plaza Accord and the Louvre Accords in 1985 and 1987 that rewrote the rules of the game. So that's what happens, and when the next collapse comes, there'll be another such meeting, and what I try to do is actually look forward and say, okay, what will the new rules of the game be? And then, based on that, go back to square one and say, what can investors do today to construct their portfolios and protect their net worth so that when this turmoil comes and when this new system comes, it's robust to that and they're able to preserve wealth.
Well, The Death of Money opens up so many territories. We're a bit spoiled for choice today when it comes to topics to discuss from the book. So let me turn to a subject that we know is a primary interest to our audience for these podcasts, and that's gold. Now, when you're writing about gold, Jim, the first thing you seem to want to do is to get your readers clear about what gold is. And in fact, you begin by explaining what gold is not. Let's look at that for a moment. For a start, you point out that gold is not paper. Why did you feel the need to make this point, and what are you telling us here?
Because Wall Street and the banks, the London Bullion Market Association banks and other financial markets participants have created a lot of products and sold them as gold, but they're not gold. They're paper contracts. And what are they? Well, you have the ETF, the Exchange Traded Fund, the most prominent of which trades under the ticker symbol GLD. But if I use a phrase like ticker symbol, it's kind of a giveaway. The GLD ETF, Exchange Traded Fund, is a share of stock. Now, the stock is in a trust, and the trust takes your money, and they buy gold, and they put it in a vault. So there is some gold out there somewhere, but you don't own it. You own a share of stock. And now you can trade it in the secondary market, and it does have price exposure to gold, but it has all kinds of other risks that gold doesn't have. For example, they could close the New York Stock Exchange, and then you can't trade your shares. And people say, oh, well, that would never happen. And I remind them that it happened very recently during Hurricane Sandy, and it happened after 9/11. The stock exchange was closed for months at the outbreak of World War I. So it can close. And if you have power outages, electronic problems, there would be another reason to close. So you're kind of locked into that system. The London Bullion Market Association sells gold forwards. These are also contracts. We're on what's called an unallocated basis. That means that you don't actually own the gold. Again, they might have some gold somewhere, but they can sell $10 of these contracts for every $1 of physical gold that they hold, and they just hope that all the holders don't show up at once and ask for their gold, because if they do, they're not going to get it. They might get a check for yesterday's closing price, but they're not going to get the actual gold. And of course, there you have, whenever the bank is on the other side of your contract, you have credit exposure to the bank. And for people who say that's not a problem, I would point them to Cyprus, where the banks closed and depositors took losses. So for all these reasons, whether it's COMEX futures, London Bullion Market Association forward contracts, ETFs, none of these things are gold. They're paper contracts. They might have some price exposure to gold. That might be a short, temporary way to sort of put your foot in the water, but it's not gold. And when the crunch comes, when there's almost a demand shock or a buying panic for gold, and the price of gold is skyrocketing, that's exactly when these paper contracts are going to fail, but physical gold will not fail, and that's how you want to position yourself today.
Well, you then explain why gold is not a commodity, and that may seem less obvious to many people. Why is gold not a commodity? It's dug out of the ground like other metals like copper or aluminum, and what is special about gold that it should not be considered a commodity?
So, gold has some uses in electronics for coatings, for connections and things like that, but very, very limited, nothing material. And then people point to the jewelry market, and they say, well, there's a big commercial market. But I just consider jewelry a form of wearable wealth. When women in India get their dowry in gold, it may be in the form of necklaces and bracelets, but they just consider that their bank account that they're wearing around their neck, and that's fine. So I consider jewelry to be a form, I call it wearable wealth, but it's really just wealth in the same way that gold is money, as I've explained, and it has almost no other industrial uses. So gold is the perfect form of money, but I don't consider it a commodity because it's not an input to anything. You look at any other commodity, copper is used for wires and pipes, and actually silver has a lot of industrial uses in addition to being a precious metal. Mining commodities are used as inputs in manufactured goods, but gold isn't. So that's why it's not a commodity. Now, I understand that it's traded on commodity exchanges, and it's reported in the commodities section of your daily website or newspaper, as the case may be, and people call it that, but it really doesn't meet the definition of a commodity because it's not an input. It's just an end use, really, as a form of money. So that's important because there are a lot of things that affect commodities that might not affect gold in the same way, and I think that's important for investors to understand.
Let me just stay with that for one moment. That last remark seems important. Can you give me at least one example of how gold is differently affected from other commodities?
Well, what if you had a global recession? Actually, we did see this in the 1930s during the Great Depression. The problem in the Great Depression was deflation. So many investors today have some experience with inflation, but you have to be 90 years old to have any recollection of prolonged deflation, because that was the last time it happened. It was kind of 1920, at least in the United States, from 1928 to 1933. Now, commodity prices were going down, industrial production was going down, unemployment was going up, but gold went up 75%. During the Great Depression, gold went from $20 an ounce to $35 an ounce. The best performing stock on the New York Stock Exchange at the time was Homestake Mining, which was a gold miner. So there's a case where commodities and economies and output around the world were collapsing, but gold went its own way. Now, it did so for very particular reasons, which was the government made it go up because the government was trying to cause inflation because they were desperate to break out of deflation, and gold led the way by government fiat. I mean, there's so much talk today about price suppression, but there was a case where the government was behind manipulating the price higher so they could get other things higher. So I'll just point to 1933 as a time when commodity prices were collapsing around the world and gold went up 75%. That's because gold's not a commodity, it's money.
You also tell us that gold is not an investment, and that may surprise listeners here who consider themselves as investors in gold. Can you explain that part?
Gold is not an investment because it has no risk, but it also has no return. Now, this is Warren Buffett's favorite criticism, and he's right to an extent. Warren Buffett said, well, I would never buy gold because it has no yield. Well, he's right. It doesn't have a yield, but it's not supposed to have a yield. The reason it's not supposed to have a yield is because it has no risk. And my example here would be, take a dollar bill out of your wallet or out of your purse and put it in front of you. Most people consider it money. Does it have a yield? No. How do you get a yield on dollars? Well, you have to take your dollars and turn it into something else. You can invest in stocks. You can invest in bonds. You can invest in commodities. You can invest in bank deposits. You can do a lot of things, and you can get a yield. But every time you do that, you're not in money anymore. You're in an investment, and the investment has some risk. If you buy stocks, the company can go bankrupt. If you buy bonds, the issuer can default. If you put your money in a bank, you could end up in Cyprus where the bank's closed and you don't get your money back. So in other words, to get a return on an investment, you have to take some risk, and you can do that, and that's what investors do. With gold, where's the risk? There's no maturity risk because it's just gold. It's not going to turn into gold 5 years from now. It's gold today, and it always will be. There's no issuer risk because nobody issues it. It's if you own it, you own it. It's not anyone else's liability. That's been pointed out frequently, but that makes the point. There's no sort of commodity risk. You know, when you buy corn, you know, does it have bugs in it? Is it good corn, bad corn? Same thing with oil. There's 75 grades of oil around the world. Gold is an element, atomic number 79. It's always just gold. So when you go down that list of things, it doesn't have a yield, but it's not supposed to have a yield because it's money, and it has no issuer risk, no counterparty risk, no credit risk, no maturity risk, no purity risk. It has no risk, and so it's not supposed to have a return. But what it does do, it preserves your wealth against all those other risks that I just talked about. And people say, well, you know, gold, the price of gold went down and the price of gold went up. That's not the way to think about it. You should think of gold as the constant and understand that it's the currencies that are fluctuating, not the gold. So when I hear that gold went up, what I say is, no, gold was constant and the dollar went down. If gold goes from, let's say, $1,200 an ounce to $1,300 an ounce, everyone said gold went up. But I would say, no, the dollar went down. It used to cost me $1,200 to buy my ounce of gold. Now it costs me $1,300 to buy my ounce of gold. The gold was constant. The dollar went down because it takes more dollars to buy the ounce. And so once you sort of go through that looking glass and keep gold constant as what economists and mathematicians call the numeraire, which is the counting device, make gold the numeraire, and then you'll see that the fluctuation of the price of gold is really a fluctuation in the value of the dollar. So the reason to own gold, you just have to ask yourself one question: what's going to happen to the dollar? If you think the dollar is going to get a lot stronger in the years ahead, you might not want to own gold. If you think the dollar is going to get a lot weaker in the years ahead, you should certainly own gold because gold will preserve your wealth. So gold is not an investment because it doesn't have risk and return, but it does preserve wealth and it protects you against all the other risks, including the classic currencies, which is what I talk about in the book.
So gold is money, but its status as money has actually been challenged quite vociferously by governments and economists, particularly in the period since America came off the gold exchange standard in 1971. Why is that? Why this campaign against the idea of gold as money?
It has to do with power. If you're a central banker and you have the power to print money, and gold stands there in opposition to what you're doing, then you don't want to say anything good about gold because it dilutes your power. What politician, what central banker, what finance minister wants less power? They all want more power. Gold actually disempowers, I hope that's a good word, but it takes power away from the central banks. So if you want to manipulate the economy, if you want to pay off debts by inflation, if you want to run budget deficits and paper it over with the Fed printing the money to buy the treasury bonds you need to cover the deficits, if you want to do all those things, and that is the condition of the modern world, then you don't want gold to have any part of the system because gold prevents all those things from happening. Now, some of this is venal. Some of it is the eggheads just not having their feet on the ground. It's funny, Milton Friedman, he died some years ago. I think if he were alive today, he might be having second thoughts. The most interesting case is Alan Greenspan. And actually, I think he would actually prove the point that you're asking about, John. Before he was Fed chairman, he became Fed chairman in 1987. Before 1987, Alan Greenspan had very positive things to say about gold. Since he left the Fed in 2007, he's had very positive things to say about gold. During the entire time that he was chairman, from 1987 to 2007, he never said anything good about gold. So it's almost as if there are two Alan Greenspans. There's the one who's not the chairman, who likes gold, and there is the one who is the chairman, who doesn't like gold. So it's almost like when you have these offices or these titles or these positions, you cannot be seen to say favorable things about gold because it will undermine confidence in the whole paper money system that you've created. Yet as a private citizen, you're looking out for your own interests, or maybe you actually care what happens to other people, and you do see gold for what it is, which is the ultimate store of wealth and insurance against the collapse of paper currencies. Another very striking example, and I was fascinated by this, and I included it in my book, The Death of Money, was recently Mario Draghi. Of course, Mario Draghi is the head of the European Central Bank, was giving a speech at Harvard, and he agreed to take questions. And one of the questions put to him was, what do you think about gold? A very straightforward question. And Mario Draghi's answer was fascinating. He said, before I was head of the ECB, I was the head of the Bank of Italy, the Central Bank of Italy, and I never sold gold. I watched other countries selling gold, and I didn't do it myself. Italy never sold its gold because I considered it a very good hedge against our exposure to the dollar, to the paper money that we held otherwise in our reserves. Well, I thought that was fascinating. Here's the head of it's probably the second most powerful central bank in the world after the Fed, saying that he thinks gold has a place as a hedge against exposure to paper money. A very truthful statement, but a fascinating one coming from a central banker, and yet it's on the record, and I quote that in my book. So if you dig around a little bit, you're right. The general consensus of academic opinion and policy opinion is that gold plays no role. But I would ask people, just ask themselves, why has the United States not sold any gold, not any material amount of gold since 1980? Why does the U.S. cling to 8,000 tons? Why does Europe have 10,000 tons? Why is China buying thousands of tons hand over fist as fast as they can? So I actually call gold, I refer to in the book as M sub-zero. You have M as a measure of money supply that central banks use, and they have M2, which is a broadly defined money. They have M1, which is really just checking accounts, and then they have M0, which are central bank reserves held at the central bank. I call gold M sub-zero, meaning the real underpinning of the global financial system.
Roughly in the same period, Jim, we've seen what's been sometimes called the financialization of the economy. And I'm referring to a growing tendency to generate wealth from financial transactions rather than from making and selling things. Now, I don't know if you agree with that picture, but if you do you see any connection between the demotion of gold and its monetary role and this trend of financialization?
It's a very good question, John. The fact is, the financialization you described, it's really cancerous, and it's what almost destroyed the global economy in 2008. I would say it practically did destroy it, except it was papered over and propped up, and will destroy it in the end. Gold output, the stock of gold, increases at a fairly steady rate. Sometimes there are large discoveries, although there haven't been any in over 100 years. It was really the period from about 1845 to 1898, early 20th century, where there were some very large gold discoveries. But since then, it's just been a slow and steady output. It grows at about 1.5% a year. Well, that's about what global population has been growing at, and so it's almost as if gold was heaven sent to grow at about the same rate as people, so we would have honest money. But if you have that, you can't financialize the economy because it can't grow any faster than that. So what you need is leverage, credit instruments, derivatives, swaps, futures, options, various kinds of notes, commercial paper. You need all that, what I call pseudo money, and I use that phrase in my first book, Currency Wars, in order to keep this game going. But the role of finance, the traditional historical role of finance, was to facilitate commerce. So commerce, which meant production, productivity, manufacturing, trade, things like insurance. Commerce was the main event. That's how you created wealth. And finance was a little bit like oil on the gears. It was a facilitator. But in the last 20 years, finance has metastasized. It's become like a cancer. It's become an end in itself. And at the time of the crisis in 2008, financialization, basically finance as a sector, was about 17% of the stock market, 17% of GDP. That's an enormous percentage. Why should the banking sector be 17% of the stock market? It should be maybe 5%, or as I say, this facilitator, but not the main event. It had become an end in itself. So it was based on greed. It was based on bankers figuring out ways to extract wealth from the system. Finance does not create wealth. It extracts wealth. It's a parasitic, what's called a rentier type of activity. And that's what it became, and that's what caused the crash in '08. And it's been propped up since. There'll be another crash soon, as I mentioned. But what we need to do, we need to put finance back in its corner, back in its box, bring back things like Glass-Steagall, make most derivatives illegal, break up the big banks, make banks like utilities where they serve a useful function and get paid a fair amount for their work, but not more than that. It's not a place to, extract wealth from the economy. It's really just more of a utility type of function.
We've talked a little bit about the push against gold by the central banks and their hostility and negativity towards it. But one theme in your book is that you see gold making its comeback in the world monetary system. And it seems as if you're seeing signs of that already, not just a future thing. What is your evidence that gold is moving back towards the center, and why do you believe this is happening?
Well, Exhibit A would be China, of course, and that story is pretty well known, but just to kind of review some of the basic facts. The last time China announced its official gold position was 2009, and they said they had 1,054 tons of gold. They have not updated that number since, and yet we know from a lot of sources that their actual gold stock is now probably about 4,000 tons. And that's an estimate. We don't have the exact number. They're not transparent about it. But we know enough from Chinese mining output, Chinese imports through Hong Kong. And I've spoken to refineries. I've spoken to secure logistics firms, not banks, but the people who actually handle the physical gold. And there's enough factual information available to form a reasonable estimate. And as I say, about 4,000 tons seems like the right number, except, of course, China's economy is growing faster than the rest of the world. And what I talk about in Chapter 9 and Chapter 11 of my book, The Death of Money, is the way to think about gold relative to a country's economy is to use a gold to GDP ratio, gross domestic product. A lot of people look at gold as a percentage of reserves, but that's misleading because the United States, for example, 73% of U.S. reserves are in gold. That shocks a lot of people. It's true. 73% of our reserves are in gold. But the reason for that is we don't need to hold currencies. We print dollars. So why would the U.S. have a big need to hang on to euros and yen and Swiss francs if we can print dollars? And the answer is we don't. And so we don't have a lot of other currencies. We have mostly gold. You go over to China. China's gold is about 1% of their reserves, and that seems minuscule, and it is quite small. But that comparison is a little bit misleading for the reason I mentioned. But what I would look at is gold to GDP. Now, there it's a much closer race. Europe is the winner, by the way. The Eurozone, the 18 members of the Eurozone, their gold as a percentage of GDP is over 4%. The United States, the number is about 2.7%. Interestingly, Russia is about 2.7%. Russia only has 1/8 the amount of gold that the U.S. has, but their economy is only 1/8 the size of the U.S. economy. So if you do the gold to GDP ratio, it comes out the same at about 2.7%. Now, the weak sister in all this is China. If you use the official number, it's only 0.7%, which is anemic. Even if you give them credit for 4,000 tons, then they get a little closer to the 2.7%. So this is what China's about. They're acquiring gold so that they have a comparable ratio to the U.S. and Europe, so that when the monetary system collapses and the countries come together, as I've described, and sit around the table, think of that meeting around the table as a poker game. When you sit down at the poker table, you want a big pile of chips. Well, gold are your chips, your poker chips. Now, that doesn't mean that we automatically go to a gold standard, but it does mean that your voice at the table is going to be a function of the size of your pile of poker chips. So what China's trying to do, they're trying to get enough gold so that when the collapse comes and they have to recut the deal, that they've got a big seat at the table. But countries like Canada, Australia, UK that have tiny amounts of gold, small fractions of 1%, they're going to be sitting, they're going to be spectators. The people with a seat at the table are going to be Germany, Russia, the U.S., and China. So this is what I mean when I say that gold I call it the shadow gold standard. And thanks to our friends, the French, some things they did in 1975 at the IMF, gold has never completely gone away. It's disparaged, it's ignored, it's not studied, the academic economists don't seem to care about it, but it never really went away. It's still there, it still matters behind the scenes. Why else would the Bank for International Settlements be intervening in the gold market, which they admit to doing? If you read the footnotes of their financial statements, that's disclosed there. And again, all this is talked about in the book, so the good thing is readers don't have to go out and do a year's worth of research the way I did. They can just look at the book, and it's all there, including the notes and the sources. So gold is still front and center in the international monetary system. It'll be even more important in the years to come.
Let me just stay with the China story a minute. I mean, there's a very compelling sort of cloak and dagger account of China's progressive secret acquisition of gold, and you talk about some of the ways this may be happening. One of the most intriguing suggestions, which I'd love you to explain, is the idea that the United States may be colluding with China in this process of its acquisition of gold. What are the signs of this, and why would the U.S. want to do that?
I've actually spoken to a number of very senior U.S. government officials in the military, in the intelligence community, the Treasury and the Fed, and also the IMF, which is, of course, not the United States, but it's a multilateral organization. And I sort of come at it a little bit alarmed and say, do you know what's going on? Or do you see these numbers? Or do you see what I see in terms of China's acquisition of gold? And the reaction is either they're unaware of it, they just haven't studied it or haven't looked at it, or if they're aware of it, it's sort of nonchalance. It's fine. It's somebody's got to own it. That was an exact quote from a very senior U.S. government official. So they seem relaxed about it, or perhaps don't appreciate the implications of it. Now, as to why, this is something going on between the United States and China. And here, go all the way back to 1950. In 1950, the United States had 20,000 tons of gold. By 1970, we were down to 9,000 tons. Well, where did the 11,000 tons go? Well, it went to our trading partners. If you traded with the United States in those days and you ran a current account surplus and you had dollars, you could cash the dollars in and get gold. And they did. Germany got 3,000 tons in round numbers. France got over 2,000 tons. Italy got over 2,000 tons. Countries like the Netherlands got 500 tons, etc. But in 1971, Nixon closed the gold window. There was a run on Fort Knox. From 68 to 71, there was like a bank run. It was a run on Fort Knox. The rate at which countries were cashing in their dollars to get gold was accelerating because they understood that the U.S. was debasing the dollar and we were heading for inflation, and they wanted to get their gold while the getting was good. Countries like Switzerland and Spain and France and others were cashing in dollars as fast as they could. So you could see that Fort Knox was going to be stripped bare, and Nixon closed the gold window, and that was that. And thereafter, if you had dollars, you could invest in stocks and bonds, but you couldn't get gold. Now, come forward 40 years. Now, it's not the European trade surpluses or the Japanese trade surpluses. It's the Chinese trade surpluses, with one big difference. China couldn't get the gold. The world was no longer in a gold. That meant if China wanted gold, they had to go out in the market and buy it. China was stuck with a big pile of $4 trillion worth of paper. They didn't have the gold that the Germans and the French got, and they, sort of looked at the situation and said, wait a second, now we're the trading giant, we're the guys, running up the surpluses, but we're not getting the gold, we're just getting this yang money from the United States. And so they went out to acquire gold, but they had to do it on the market, but that meant they had to suppress the price, because if their intentions were known, if their actions were transparent in a thinly traded market, obviously when you have a giant buyer in a thin market, you know what happens, the price goes up. And with the Chinese economy going the way it was, and Chinese intentions being what they were, and in a thin market, they would have caused the price of gold to go up faster than their ability to buy it. So you had to do a couple things. You had to keep it secret, and you had to keep the price of gold down, and the statistical evidence for price suppression, the anecdotal, legal, and other evidence for price suppression is abundant, and I talked about this in my book. The idea that somehow, that's like a deep, dark conspiracy or whatever is just not true. I mean, the evidence is very clear. But it makes sense, right? If you're China and you're out to buy thousands of tons of gold, wouldn't you want the price to be lower? And so, but from the U.S. point of view, if we stiffed China, if we said to China, sorry, our other friends like France and Germany, they were allowed to get the gold, but you're not. You're stuck in the paper dollar world. Well, they would have rejected that because they would have seen the implications of it, which is we were going to steal their money through inflation, and we were going to ignore them when the new international monetary system was restructured. And so they went out to look after their own interests, to protect the real value of their wealth, and to have a big seat at the table by acquiring gold. And the U.S. didn't have a problem with it because we didn't want a financial war with the Chinese. So you put it all together, and it all makes sense, and it's consistent with the actions. It's consistent with the data and the information we have. But it's getting closer to the end, and it's getting closer to the point where, when China actually does have the same ratio as the U.S. and Russia, maybe a little higher, maybe they're aiming to be a little closer to Europe. When that happens, now they're no longer off the bus, they're on the bus. And then you can let the price of gold go anywhere as high as you want, and the Chinese won't be disadvantaged. If the price of gold took off before China had all the gold they needed, China would never catch up. But if China has the right amount of gold, then no one cares where the price goes, because China will be in the club, and they'll be, whatever they're losing on the paper, they'll be making up on their gold. That's how much gold they need. But when they get to that position, then you're hedged, as is the U.S. and Europe. So this is the grand plan. This is the really, you peel away all the layers of the onion. This is what you see is a global rebalancing in gold, getting ready for a reset of the international monetary system.
Let me ask you then a little bit about the price of gold, and bearing in mind what you said earlier, that in a sense the price of gold is deceptive because it's the value of the dollar that's going up and down, not the value of gold. Nevertheless, on a sort of common sense or practical level, we see a price of gold each day, and it varies. And I'm not an economist, and for me there's a puzzle in this story because I tend to assume that prices of things are driven by the laws of supply and demand. And when I look at the global market in physical gold, it seems that, bearing in mind, for example, your reference to the purchase of gold by the Chinese, there's a massive increase in demand, but there's no obvious increase in supply. So why isn't the price of gold responding to this mismatch?
Well, because of the price suppression through the paper market. Now, when you look at the physical market, and we talked about that a little bit earlier, as I say, I met with this gold refiner in Switzerland. He's one of the largest refineries. His factory is working at flat out triple shifts, 24 hours per day. He is selling all the gold he can produce. He produces, the one I met with, which is one of the biggest ones, produces 20 tons a week. 10 tons of that are going to China, so that's 500 tons a year to China from a single refinery. And the Chinese want more, but he won't sell it to them because he has to take care of other customers, like Rolex and other watchmakers and jewelers and people who need gold. So he's selling all the gold he can make to China. China wants more. They want as far as the eye can see. He's sold out a year in advance. And he's actually having difficulty sourcing the gold because the refinery takes gold from various sources, melts it down, makes it pure, and puts it in different form and sells it to the customer. He's having trouble getting the gold in the door so he can continue to get gold out the door in the form that the Chinese want it. The warehouses are being stripped bare. 500 tons came out of the GLD warehouse. COMEX warehouses are near all-time lows. I also met with vault operators, the secure logistics people who actually move the gold and store the gold. And they told me they cannot build the vault capacity fast enough. They're actually negotiating with the Swiss Army to take over. There are these huge mountains in the Alps that are hollowed out. They were basically military bases inside with tunnels and chambers and ammunition dumps and other, railroads inside mountains. Well, the Swiss Army is abandoning some of these, but they're offering it to the vault operators for gold storage, with secure perimeters and all that. And so they're negotiating to get that. And they're seeing gold coming out of the banks, such as UBS, Credit Suisse, and Deutsche Bank, into private storage at places like Brinks and G4S and Viamat and the other vault operators. So when you look at the physical gold world, the vaults and the refiners, they can't keep up with the demand, either for storage or for newly refined gold. So that's what's going on the physical side. The shortages are popping up. There are delays in delivery, et cetera. So the logical question is, well, gee, Jim, if all that's going on, why isn't the price skyrocketing? And the answer is, well, over here in the paper world, massive shorting of futures, massive short sales of unallocated gold. These operations are continuing to keep the price down. So it's a struggle. It's a tug of war. And so far, the gold is holding its own. It certainly got whacked down from where it was at the all-time high in August 2011, but hit some lows. It's come back from there. Look, it's volatile. When you have a tug of war, it's volatile. You've got two powerful teams pushing against each other or pulling against each other. You've got the central banks on one end of the rope, and you've got smart investors on the other. And there's a lot of force on that rope right now. But it's just a matter of time before the manipulation ends, because it always does. The manipulation can't go on forever. It can go on for a long time. it can go on longer than you think. But sooner or later, an accident happens. Something will happen. Don't know what it is, but it could be a failure to deliver. It could be a default. It could be a prominent suicide. It could be a run on the bank, a demand shock. All these things are in play, and any one of them would just cause a buying panic, and then that's the beginning of a skyrocketing price of gold.
So I wanted to ask you about that because we've got this extraordinary leverage of gold in the paper markets. I think you mentioned 10 to 1 in this interview. I think you talk about 100 to 1 in some cases in your book, of paper to the actual physical gold. It feels very unstable. I mean, as you suggest in what you just said. So what happens if something breaks? What would a crisis actually look like if all these paper holders suddenly wanted the real thing and asked for their gold?
Well, if they all wanted the real thing, there's nowhere near enough gold, and you'd have a buying panic. But just to put it in dynamic space, John, it is unstable. And here's a simple way to think about it. Imagine the gold market as an inverted pyramid, an upside-down pyramid where the peak of the pyramid is pointing down and the big, fat, wide base is up on top. Underneath that, let's call it the paper pyramid. So in that paper pyramid, you have leasing, gold futures, unallocated gold forward contracts, gold options, ETFs, all the paper forms of gold that we talked about. At the bottom of this pyramid, on the ground, under that little point supporting the whole thing, are a couple bricks of real gold. So you have a little bit of real gold supporting a much larger inverted pyramid of paper gold. Now here's what's going on. When gold moves, let's say, from the GLD warehouse to China, to the government of China, to vaults in Shanghai, which it has been, and that's well documented in the book, a lot of people shrug and say, well, so what? The total supply doesn't change. So I took a brick of gold in London and I plunked it down in Shanghai. It's still gold. It's still the same amount. Nothing changed. But something did change. It is true that the total stock of gold is unchanged, but the floating supply dropped. And what is the floating supply? The floating supply is the gold available for trading. It's the gold available to support the paper gold. So if gold is in a bullion bank or in a GLD warehouse or in the COMEX warehouse, it's part of the floating supply. It's available to support paper trading. But once it gets to China and goes in that vault, or it gets to Viamat in Switzerland and goes in that vault, it's no longer part of the floating supply. It is part of the total stock. But if it's not available for trading, it's not part of the floating supply. So that's exactly like pulling one of the bricks out from under this inverted pyramid I talked about. The gold's still there, but it went to a different place, and it's no longer available to support the paper trading. And that's what's going on. Total supply is almost unchanged, but the floating supply is dropping radically, which means that the pyramid is getting more and more unstable because the base on which the whole thing rests is shrinking. It's just a matter of time before it tips over and collapses. Now, how would that play out in the real world? It could be a lot of things. If you have a credit crisis in China and a run on the banks in China where people are worried about their investments, and I do expect that. That's a separate chapter in my book, Chapter 4, nothing particularly to do with gold, but it has to do with China, and explain why the credit crunch comes. Well, when that credit panic comes in China, the Chinese have a closed capital account. They can't invest abroad. They don't want to invest in Chinese stocks because they've been going down. Real estate's the very thing that's going to collapse, so they won't want that. And the banks don't offer anything significant on their savings. So what else would you do? You'd buy gold. And I actually have met some very, very senior, can't mention names, but very senior commodities traders, head trader really, of one of the largest banks in the world. And he foresees a demand shock coming from China where there's panic buying. Or if you have an MF Global type default, or, a bunch of people and there's not enough gold to go around and they terminate the contracts and they pay you cash. They don't steal your money, but you want the gold and they give you a check instead. Well, what good's the check going to do if you can't get the gold? That's what you really want. So something like that will happen, maybe all of it, and then that'll start a buying panic. And so I expect the price of gold on a short-term technical basis to go up gradually over the course of this year. But then that rate of acceleration will increase, and then there'll be a hyperbolic phase, a super spike, the kind of buying panic we talked about. The problem then is that a lot of people want to jump on the bandwagon, but you might not be able to get the gold. There may come a time when the physical supply is so small that you can't get it even if you want it at the much higher price. And so the time to get it is now.
That was going to be my last question, so maybe you can expand on that a little bit. You've talked about throughout this conversation and very powerfully in your book about effectively an unsustainable monetary system, a system that is bound to break and reset at some point in the future. And you've also more immediately here talked about the unsustainable character of the paper gold market, the paper market over gold. With that context, What are the implications for individuals who are seeking to preserve wealth?
Well, the implications are pretty clear. You need some physical gold in your portfolio. Now, I recommend 10 to 20%. I recommend 10% for the conservative investor, 20% for the aggressive investor. And a lot of people say to me, well, wait a second, Jim, you're the one talking about the collapse of currencies and skyrocketing price of gold. Why wouldn't you go all in? Why wouldn't you have 50 or 100%? Well, the answer is it's never a good idea to go all in. That's just never a good idea. And secondly, gold is volatile, and you want some other things in your portfolio to damp down the volatility. And third, there are other assets that will preserve wealth the way gold does, but they're not gold, and so you can get a little diversification if you're in land or fine art or some other things that behave the same way. But 10 to 20% is plenty. By the way, institutions around the world have about 1% in gold, a little more than 1%. So there's a lot of headroom between even 1% and 5%. If institutions only went to a 5% allocation, which is a lot lower than I recommend, there's not enough gold in the world at these prices to come anywhere near filling that demand. That by itself, just that kind of reallocation or rebalancing of portfolios away from securities toward gold, just to the extent of 5%, would send the price of gold skyrocketing. So, you don't need the end of the world for this to happen. You just need fairly small changes in behavior and perception for this to start to happen. So I do recommend that for investors. I think these are very good entry points in here. As I said, it's volatile. It could go down tomorrow. I understand that. And I'm not predicting tomorrow's price. I'm trying to look a year, 2, 3 years down the road and see what's going to happen. But I do know that when the crunch comes, the big guys are going to get all the gold. The institutions, the central banks, the people with the relationships with the refiners, they're the ones who are going to get the gold. Small investors may find that they can't get any, that they go to the local gold dealer and the guy just says, sorry, the mint's running 2 months behind on the orders. I can't get my usual allocation from my wholesalers. You just may not be able to get it. Meanwhile, what's happening to the price? It's running away from you. It's going up $100 an ounce per day, $1,000 per ounce per week. It's running away from you. You want it, but you can't get it. That is what a buying panic looks like. That is likely, and therefore get your gold now while you still can, and then just sit tight and, don't worry about it. But don't go all in either. Just get 10% gold, put it in a safe place, sit back and watch the show, because it's not going to be a very pretty show.
Well, thank you, Jim Rickards. It's been great having you with us today.
Thank you, John.
And thank you to our listeners. You can follow Jim Rickards on Twitter. His handle is @JamesGRickards. And speaking of Twitter, please share your questions for our next podcast using the hashtag AskJimRickards, followed by your question. Wherever you post that on Twitter, we'll find your question and we'd love to hear from you. Meanwhile, don't wait another day to get hold of The Death of Money. It's packed with insights and with information that you won't want to miss. And apart from that, take it from me, it's a real page turner. I can promise you this is a book you'll learn a great deal from and you will enjoy reading. So goodbye for now, and we look forward to joining you again soon.